Good morning, everybody. Welcome to the morning market briefing, Thursday, February 24th, 2022. I was chuckling a little bit to myself this morning. I do that a lot in the mornings, actually, but I was kind of laughing to myself about how a couple of weeks ago we said we were going to have a diplomatic boycott on Russia, and here we are. That did not work. As a show, we were unable to prevent what is now a full-scale invasion of Ukraine by Russia. I'm sure everybody on the call has been seeing images following all that. As a bit of a disclaimer to open up here, we're going to talk a lot about market impacts, some themes we're seeing, potential responses, all of that. We don't want to be insensitive to the fact that there are more important things than how stocks do on a day-to-day basis. So, obviously, let's start by acknowledging just the bloodiness of the conflict that's underway. With that, I want to jump in. We do have Ben, who's supposed to be out today, but he is joining us by phone. We got Tom Russell. We may even hear from Sam Frost a little bit on this. But want to talk, first of all, about just kind of the high-level takeaways. And Ben, I'll throw it to you. I know you're just on your phone. But just based on where we are right now, what are the big takeaways? And we're going to get later to just kind of actual economic impacts and what we're doing here tactically within portfolios, but just at a high level, kind of assessing the situation. How do you see it?
Yeah, thanks, Andrew. It was becoming increasingly obvious to markets, I think, and I think that it's definitely one of those things that the markets has been pricing in this risk for some time. I think that's number one. But then when it actually happens, it definitely has a secondary impact. And so what I'm seeing right now is you're beginning to see these tacit alliances begin between the countries that basically have not condemned this Russian invasion. And that would be Iran, Belarus, and China. There are other reports of China doing things this morning. I'm not sure how substantiated those are, but that's going to continue to be something to watch. So that's number one. Number two is, I think it's very clear that sanctions are coming, severe sanctions, potentially disallowing the banks to really move money in and out of Russia, basically shutting down the Russian banking system. The problem is, and they call this the SWIFT payment system, that's the international payment system. And the problem with that is that if they were to shut down the SWIFT payment system, then Russia says that they will stop all of their oil and gas exports. 40% of European natural gas comes from Russia. The Europeans right now have said that they're not yet willing to sign on for that, although Boris Johnson did say that they're at this point maybe beginning to start taking some pain in the interest of really hurting Russia. And then you also have this address by Putin, where he referred to Russia being a nuclear power as an extremely dark sort of an address, obviously. I mean, he's starting a full-scale invasion of Ukraine. And so that's kind of what I'm seeing on the broad level. I think there are certainly market impacts on that. If you're talking about the European banks, which are selling off significantly this morning, European industry, a lot of European industry relies on natural gas and the electric power that's provided from them, crop prices, oil prices, and this could really perpetuate the inflation that we've been seeing. So that's what I'm seeing as terms of the immediate impact on the economy and really the markets.
Tom, I want to throw it to you. I would echo Ben in that it is interesting to see, kind of these alliances forming of those refusing to condemn this. I don't know that I'm necessarily surprised by that. A lot of this, to me, I don't want to put myself in a position in which I'm living in a glass house and people are throwing stones at it, but a lot of this is not necessarily surprising in terms of some of the reactions from people. To hear Putin's address, I'd echo Ben, where he kind of threatens a response the likes of the world has never seen if there's interference by the West. That seems a little bit par for the course. That I don't think those are necessarily hollow words. But, to kind of see these countries, some countries rally one way, some rally the others, I think they're kind of playing their part to perfection. And at the end of the day, I think everyone, we were certainly critical, a month ago when Biden had his press conference, when, we watched that in the kitchen and it felt like he was really opening the door for Putin to invade Ukraine. It was almost an invitation. And I think we've probably at times maybe even been overly critical of Biden. The reality is Putin was going to do what Putin wanted to do, and he's going to do it when he wanted to do it. I think his timing, I'm not giving the guy credit. I think he's obviously a scumbag, but his timing was good when you look at just the priorities and the other challenges nations around the world are facing. He was able to relatively quickly mobilize and move and create a national story in which it was pretty clear that people weren't going to stop him. But Tom, I want to throw it to you, just kind of high level, what's your read on where we stand right now?
Yeah, just to tack on one extra piece there for what you're saying is I think that the one strategic thing we did poorly is we have basically shut down the procurement of oil in the United States in the last year. We basically said, hey, we're going to buy oil from other places. We're going to get green. We're going to have all this green energy. And the price of oil has skyrocketed. And guess who that benefits the most and is the biggest bargaining chip in this whole thing? It's Vladimir Putin. So he's been emboldened, but a lot of it was our doing. I mean, we basically gave him his own bargaining chip, and now we're suffering the consequences. In terms of bond land, we're finally starting to see this is priced in as a real thing. For the last couple of days, we've seen almost no movement on bonds, which would indicate, there was no real fear factor based in the market. But today we're seeing a big step up in buying of bonds. The 30 years dropped significantly. The 10 years dropped significantly. The front end of the curve, obviously, is still pricing in rate hikes. So it hasn't moved nearly as much, but the number of rate hikes that futures are indicating has dropped also precipitously. Now we're looking at, there's very low probabilities now that we'll have more than one rate hike. In March, we're looking at one now and 6 maybe for the entire year, but even that's dropping as we speak. In terms of the Russian bonds, I mean, they've just gotten absolutely crushed overnight. So we talked about it yesterday. The Russian 10-year has moved all the way up to 11%. Well, overnight it went from 11 to 15. And so on a price basis, you're looking at, roughly a 20% loss on anybody holding that overnight. So that's very painful for them. It's going to be very difficult for them to issue new bonds. It's a great opportunity if you're China and you're looking to, basically infiltrate and kind of be a puppet master for Russia. They need money to start this war and run this war, and you're the only one willing to deal with them, where you're going to get paid very handsomely for that and be a holder of their debt. So, Russia's opening itself up to manipulation, I think, from China, which is what China likes. And I think that's probably what we'll see as a result of these sanctions. So something to keep an eye on. I mean, it's just a bad situation. Obviously, this is not the outcome we wanted, but it was one that I think the door was left wide open for weeks now.
Yeah, I think the oil thing is interesting. Biden killed the Keystone Pipeline before he had a cup of coffee as president. I mean, there's been a pretty consistent push to reduce access to oil here. I think it's going to have massive impacts on the price of oil. We've seen already oil just really, really taking off this year and just absolutely skyrocketing. Right now, I mean, looking at crude oil over $100. So it's, it's going to have an impact on all of these. I think there's going to be underrated issues on the supply chain. I think and not necessarily because, we are waiting on this product out of Russia, but there's just going to be a bog down created by the energy situation. I think you could have an implication on crop prices. And I'm interested, Tom, I mean, when we talk about the Federal Reserve, I think this conflict only extends, if not heightens, the inflationary environment that we are in for all the reasons we just mentioned, specifically as it relates to gas prices on a day-to-day level. It is going to be interesting, in my opinion, to see how the Fed really navigates this, because the market has obviously also been relatively harsh against the idea of a double rate hike, which would be in place in no small part to try to curb inflation. but now we have this exogenous force that's really driving gas prices up. Do you think that changes how the Fed is thinking in any way as we come up on the March meeting?
I think, yeah, I think the early estimates I've seen is that inflation could go as high as 9% based on this. And ultimately, I think, unfortunately for the Fed, they don't really have any tools that can. Raising interest rates isn't going to change the fact that 10% of the crops coming out, or 10% of the wheat grown in the world is grown in Ukraine. It's going to drop off the map. It's not going to affect the fact that 40% of the European oil is going to be turned off if we go to war with Russia. That has nothing to do with supply and demand factors that the Fed can manipulate by raising rates. And so they're going to be pretty hamstrung. And so I think that ultimately, even if we do start raising rates, it would be about as effective as a fart in the wind. You know what I mean? It's just going to not be anything. And so that's the fear I have, is that, we basically put ourselves in this position where, Putin's just taking advantage of it, man. I mean, it's a great time. The timing is unbelievable. We can't really raise rates to curb inflation because the inflation is not driven by demand. It's driven by, exogenous forces like war and like supply chain issues. And that has nothing to do with what the Fed does. And at the same time, oil is at an all-time high, at least a high that we have not seen in, 5-6 years. And that benefits them as well. And there's not really much we can do about that either, because we've shut off all of our pipelines, and it's going to take us a really long time to get that production up and running again. And so we're really over a barrel here, and it's mostly self-inflicted. It's tough. I think at this point, the Fed's really have to reassess. I think raising rates is going to be something they will do. I just don't think it's going to have as much of an effect. I mean, they're effectively neutralized. Should we go to and have a full-scale war here, and the economic sanctions start pushing oil prices up?
Yeah, thanks, Tom. It's interesting to see Boris Johnson kind of echo, I felt, in a lot of ways, similar messaging that we've heard from Kamala Harris, Vice President, as well as Jen Psaki at the White House, in terms of just, hey, we're going to have to bear some of the cost of this conflict here locally at home, and it's going to be a literal cost. And it's a little bit unfortunate, but in some ways, that's probably what's going to make a lot of people pay attention to this whole situation. And I think Putin put everyone in a position. I mean, the sanctions thing, Ben, I don't know if you have any thoughts on the sanctions. I mean, I'm not totally comfortable that they're as targeted as we think they are in terms of really causing a concern. And part of that stems from the fact that, Putin's got billions and billions of dollars of reserves in his war chest. How do we really hit Russia to an extent that, people in Russia feel the pain to the extent that Putin feels like he has to change course?
There was a good Bloomberg article, actually, to that point, Andrew, that came out this morning that basically said even within the White House and the administration, there was a concern that sanctions can't really do anything and they're not going to dissuade. I do think that economically it would hurt Russia at the margin, but Putin's obviously not making this decision based on information at the margin. He's making these decisions based on a completely different part of the brain than saving money at the margin. So I would agree with you. I also think that we don't really have many options. I mean, Ukraine's not part of NATO. If Russia did invade a place like Poland, then yes, we would then have a hot war, because we'd then have to come to the defense of Poland. But right now, we've taken that off the table with Ukraine, so we don't really have any options. We've promised these sanctions, and we kind of have to go through with these sanctions because we've said that's what we're going to do. But in terms of dissuading Putin from doing this, obviously it hasn't had a negative impact so far.
Yeah, I put my tinfoil hat on for a second. And my theory is this: they're going to launch some sort of cyber attack on Ukraine, and since cyber attacks have no borders, it's going to spill over into Poland, and that's going to be the excuse for NATO to jump in. That's just my tinfoil hat. It may not happen that way, but that's sort of me reading between the lines. Whether or not we attack ourselves with a cyber attack, or or Russia actually attacks Ukraine and spills over. I think that's the path forward, at least as a Again, tinfoil hat, conspiracy Tom. Sorry.
Conspiracy Tom is one of my favorite times. Let's talk a little bit about what we're doing in portfolios. I mean, I think a lot of people on this call are on every single day. This will be a little bit repetitive to you all, but I think it bears repeating. So we do have some people that aren't on every day, so appreciate you jumping on. In terms of what we're doing tactically, I mean, this is really the point in time in which we really lean heavily on discipline. We do not want to be overreactive. You know, I was talking with someone, you know, we're not running with a Russia invades Ukraine opportunistic strategy here. We're just not. That's not how we're structured. That's not how we want to invest. We want to invest in a more methodical and less thematic way. We're leaning heavily on asset allocation. And I think it's important to remember when I look at the markets, one of the things I try to really emphasize with people that are retired is at some point the time actually becomes more valuable than the money. And when you think about the S&P, we've essentially at this juncture marched back to where we were last summer. Nobody likes going backwards in terms of value, but you know, this is not as cataclysmic as I think some people maybe are interpreting it. It has been relatively quickly. I continue to think that had some of this happened mid-year, it would have been less of a big deal, but it happened to come out at a time in which everyone's thinking about setting up their year. Everyone's thinking about how retirement projections are looking, how income projections are looking. It's just a bad time to open a year on such a negative note. And so when we look at the market, I think it's important to remember that as we ran up through 2020, after the COVID recovery, through 2021, we were consistently trimming equity exposure to keep allocation tight. So we've been consistently buying over the last 6 or 8 weeks to keep equity allocations tight. We've been consistently really micromanaging those asset allocation targets. And that's when we look at market level returns for a balanced portfolio, you're not down what the market is. And I think that's a really important note that we want to get out there. We own defense stocks. We have oil exposure. We've invested in some businesses that are likely to benefit in some ways because of this conflict, but that's not necessarily the catalyst for why we've invested in them. But I think more importantly, we really try to own a portfolio in which we do not expose ourselves to permanent impairment of capital. And when you're thinking about how do we avoid permanent loss, our view is that we avoid that by holding good companies that have withstood the test of time, different market conditions, made it through war cycles even. So when we look at kind of our core holdings, we are confident that where we're positioned, we're going to see some strength. Now, you're going to have days like today, and I think this is important to recognize. You are going to have days like today where things are ugly. You know, Dow futures are down 2.5%, NASDAQ futures down more than 3%, S&P down about 2.5%. When you have those days, there are times where, you know, correlations essentially move to 1 and everything trades down with it. That creates opportunities, number one. But number two is we're not managing any portfolio for a single day return. Tom, Ben, I don't know if you have anything that you would want to weigh in on in terms of tactical moves, opportunities you see, and kind of ultimate outcomes.
Yeah, I'll hop in quickly. I think it's important to remember today too that fixed income is serving its purpose as a portion of the portfolio. Fixed income holdings will be, assuming the move remains what it is, that will actually be up today, offsetting some of those equity declines if you have fixed income. And this gets back to why the asset allocation is strategic, because if you're closer to your retirement or you're in retirement, you have some of that fixed income in the portfolio. And this is exactly why you have that. And if you don't have fixed income, if frankly, you're like me and you're on the younger side and you're predominantly in equities, today on a percentage basis really hurts as a percentage of your current net worth. But you also have, there's a lot of time left. You got probably, in my case, I got 30, 40 years until retirement. And I'd probably be foolish to think that I could make it for 40, 50 years of a career without a war or a 12% drawdown or things like that. And actually, these things can accrue to one's benefit, because then you can purchase with new income at lower levels. So I think that's important to remember. And then in terms of some of the names that we're talking about, we have the Narwhal Core Holdings list, which are these companies that have withstood, as Andrew mentioned, the test of time, persisted through wars. I mean, we have banks, we have JP Morgan. It's made it through 2 world wars. It's made it through the Great Depression. It's made it through the financial crisis. Yes, JP Morgan will probably be down decently today, but we have confidence that it will still be around going into the future. So it's companies like that we are invested in, and that's what gives us confidence that we'll make it through this okay.
Tom, anything to add before we wrap up?
Yeah, I mean, this is why we own bonds. And something to think about too, if you're actively in retirement too, just because the stock is down doesn't mean, if you're drawing income, that the income is going to change at all. I would take Target, for example. Target is what they call a dividend aristocrat. It's paid a dividend and increased their dividend every single year for 25 years or more. So, even during the financial crisis, they paid a dividend and they increased it that year. And so I think that's important to remember, especially if you're actively in retirement, that the income's not going to change. On your bonds, the income doesn't change. The prices may fluctuate, but that money is still going to be rolling in. And, as that money rolls in, if you're not taking all of it, or we've got an account that we're not pulling from, we can use that money to buy stocks at a lower price and potentially increase that income today.
Completely agree. We're going to wrap it up there. A little bit of a different show today. Obviously, only one real news story commanding attention. We will have this up on the podcast feed. We can send out a link if you'd like it. I think it's useful to think through these things methodically for those who've been on the call for a long time. Hopefully you didn't see there's not a real stark change in our tone. This has kind of felt a little bit like an inevitability for a while. As Ben said on the onset, a lot of this conflict has been priced in on the market. In the grand scheme of things, I think we're going to see opportunities. We're going to continue to act. But, if you have anybody that would be interested in the commentary, you can put them in touch with us. We can share it. We appreciate you guys, as always, for being on, especially now. Remember why we started these calls. We started these calls at the beginning of the pandemic back in 2020. There have been some really boring shows along the way, and we recognize that. But I do think kind of having a combined understanding of how we're investing, why we're investing the way we're investing, what we're seeing over time. I think the goal here is that it gives you guys confidence in what we're doing, and I hope that is the case. If you have questions, though, on your individual portfolio, where you're sitting, things like that, want some analysis, please reach out to us. We would be happy to hop on the phone with you, send you an email, whatever it may be. Speaking at a high level, the markets have been ugly this year. We're outperforming pretty well for the most part. We're doing pretty well on fixed income, pretty well on equity. When we stay disciplined to those allocation targets, which we try to do in all cases, that tends to be a good formula. It may still be a negative number, but don't be blinded just by the return of the S&P 500 on days like this. So appreciate you guys. As always, we'll be back tomorrow morning at 8:30, and we will talk to you then.